Welcome to Policy on Demand. I'm Scott McCandless. It is the week of January 23rd, and this is your Monday briefing. Both chambers of Congress will be in session this week, with the House returning from a one-week recess and the Senate returning from a nearly three-week recess. Additional organizing for the 118th Congress is expected this week, including with respect to the membership of both congressional tax writing committees. Meanwhile, the IRS opens the 2023 tax filing season today, and President Biden will deliver the annual State of the Union address to a joint session of Congress on February 7th. This will be followed by the President's FY 2024 budget submission, which typically is accompanied by a Treasury Green Book explanation of revenue proposals in the President's budget. And here to discuss the current economic climate facing both the country and the Congress is Karl Russo. Karl, welcome. Thanks for joining us.
Thanks for having me, Scott.
Karl, let's start with the debt ceiling. We were told by Treasury that we reached our debt limit on January 19th and that they now have to employ what they call special or extraordinary measures to deal with the situation. Can you explain what those measures are and what Congress needs to do to respond to this?
So the primary tool in the Treasury toolbox is not reinvesting the employee retirement funds for federal employees. These are normally invested in Treasury securities that count against the debt limit, and if they're held outside of that, can provide some additional room for borrowing for other purposes, somewhere in the neighborhood of about $300 billion. Okay. And those employees will be made whole at the end of the day when the crisis is resolved. To resolve that crisis, Congress is going to need to make some decisions about whether there needs to be an increase in the borrowing limit for the U.S. Treasury, or whether there'll be some combination of spending cuts and or tax increases that could address the deficit and the debt more in the long term. In the current environment, it looks like tax increases are probably off the table given the makeup of the House. But we'll see what that package looks like. And if not, then we start to get into situations where there could be more pressure on the financial markets to deal with the potential exhaustion of those extraordinary measures.
Just quickly on that exhaustion issue, what's the runway? What's the timeline before we exhaust them?
So Treasury expects that they can use their current tools until at least June. Okay. There's some uncertainty about that based on how strong tax receipts are when people file their tax returns on April 15th. If receipts are robust, then they might have a little bit more runway. And if they're weak, depending on the economic conditions, then they might hit that limit sooner than they expect.
So, Karl, with regard to the broader economy, I believe we added 223,000 new jobs in December. So can you talk a little bit about where the labor market stands?
Yeah, so the labor market has been a relatively bright spot in the economy. We still have unemployment at near 50-year lows at 3.5%. That recovery rate at 223,000 jobs is slightly lower than it's been in the previous months. We've actually seen a decline for several months in a row, but it's still higher than the average job growth in the last recovery. And so demand for labor is still pretty robust. And that's one of the things that the Federal Reserve is hoping that they can address with their interest rate increases to try to take some of the steam out of the labor market without sending the economy into a recession as they continue to fight inflation.
You had mentioned inflation, and I believe the inflation rate is now at 6.5% as of December at the end of last year. Can you talk a little bit about that inflation rate, where it stands, where it might be headed, and what it might mean for the broader economy?
So the Federal Reserve has been more forward-leaning, I think, and acted sooner than in previous bouts with inflation. And we do see that there's been some moderation in both the headline inflation rate at 6.5%, but also in the so-called core rate of inflation, which takes out the volatile food and energy price changes. But when you compare that to where we were before the pandemic, we had inflation rates that were around 2.5%. And so even the decline that we've seen from the high of 9 still leaves us at a relatively high rate. Forecasts for this year expect inflation to run about 3.8% for the year, which would still be much higher than what we were experiencing before the current bout.
And with regard to GDP, we're expecting the fourth quarter GDP report to come out this Thursday, looking back at what happened at the end of 2022. What's the expectation for that report, and what does the GDP outlook for this year mean for business?
So the the economy forecast for the fourth quarter vary in the projections that we're seeing right now. So the Atlanta Fed is expecting growth of 3.5%, but the broader consensus forecasts are about half that. Okay. And so there's still considerable uncertainty in how strong the economy was performing at the end of last year. But most people expect that in the current quarter that we'll see a negative GDP growth, and that might be followed by a second quarter of declining GDP in the second quarter of this year. So we still have considerable headwinds on the economic front, which businesses will have to contend with. There may be a decline in demand on the part of consumers, but as they are looking to try to plan forward, we do expect to have a stronger recovery at the end of this year by the fourth quarter, and likely the U.S. economy will be performing better than some of those around the world. So we'll be a relative bright spot here on the GDP front.
I appreciate just a little bit of silver lining there at the end of the economic report. Karl, thank you very much. Really appreciate your insight as always.
Well, thank you again for having me, Scott.
Thank you. And for our viewers, be sure to check out the latest Week in Review with Will Morris, as well as a special episode around our 2023 tax policy outlook included in the description of this episode. And as always, stay tuned for this Friday's Week in Review. As always, thank you for spending this time with us. Have a great week, and we'll see you next time.